Hi, Adam Bergman. Thanks for everyone attending, viewing, watching. We'll be starting in a couple minutes. Just going to give everyone a chance to sign in, log in. This is going to be an exciting presentation about some really kind of secret sauce strategies that not a lot of people are aware of. And this is only going to be open to clients of IRA Financial that are in compliance with our annual compliance service. So if you are, and about close to 95% of our clients are, so this is open to all 14,000 of you people, and you should really take advantage of this because there are some really cool strategies I'm going to talk about that could really open up some investment and retirement opportunities for all of you. So I think this is a worthwhile presentation. I'm going to probably talk for about 35-40 minutes and then maybe take questions. There's probably going to be quite a few questions because of the topics. So I'll leave some time if I don't get to all of them. We'll either do another session, question and answer session, or I'll try to address them individually in a separate video or a separate podcast or blog. So let's see how it goes. I'm going to give everyone another minute or so to get organized, get settled, and then we're going to start. And this is going to be a lot of fun. I think this is going to be very interesting and highly impactful for most of you. So just a few more minutes. Again, I'm Adam Bergman, President of IRA Financial. You probably know a bit about me. I am a former tax attorney. I have a master's in tax law. I've written 7 books. I'm working on my 8th book. It's actually going to be about millennials and the power of retirement saving. So it's going to be a broader based book than just self-directed retirement plans. That should be out in a few months. I write regularly for Forbes and obviously very focused and committed to the area of empowering Americans to save for retirement and save their way. Using an IRA or 401k to invest the way they want to, because that's what the IRS has allowed us to do. Unfortunately, not enough people know you can do it. So again, the topic is tax strategies to maximize your self-directed retirement plans. Be about 45 minutes or so, then hopefully we'll have some time for Q&As. I think this is going to be a very interesting topic. I thank the hundreds of you that registered. If you've not been able to register, it'll be available to all our clients that are in compliance with our annual service, which is getting close to 95% of all our clients. So that's really good because there's some very beneficial information here. So let's get started. Again, thanks for watching, listening, viewing. Let's briefly just talk about obviously the types of self-directed retirement accounts, IRA LLC, which is a checkbook control, and the solo plan, which is if you're self-employed, have a business with no full-time employees other than yourself, a business owner, or a spouse, you can establish a solo 401k and maximize contributions. The 2019 IRA contributions, $6,000 if you're under 50, $7,000 if you're over 50. For a solo K, it's $56,000 or $62,000 if you're over 50. And we'll talk about some of the strategies for maximizing the solo K and even the IRA contribution strategy. The investments, basically kind of the same rules about what you can and cannot do. Unbeknownst to most Americans, you are allowed to do more than mutual fund stocks and ETFs with your retirement accounts. Section 408 and 4975 only discuss what you cannot do. There's basically only 3 things. In an IRA, you can't buy collectibles like art, life insurance, and you cannot engage in any type of prohibited transaction listed under 4975 of the code. And just to summarize what 4975 means, it basically says you cannot do any investment that directly or indirectly, personally involves or benefits you as the IRA owner or your lineal descendants, your parents, your children, your spouse, daughter-in-law, son-in-law, or any entities controlled by such persons. So you can't buy a house and live in it, can't take your IRA, buy yourself a car, take your IRA and pay for your kids' college. With a 401k, the only distinction is you're allowed to buy life insurance so long as your plan allows for it. So from an investment standpoint, IRAs and 401ks are quite similar. Obviously, contributions are much higher on the solo K. There's also a loan feature on the solo K. And there's something called an after-tax contribution option, which we'll get to in a second, which is a really exciting strategy that we'll focus a little bit of attention on. So what's the advantage of setting up an IRA or 401k? So clearly deferral is the big one, right? When you invest with personal money, non-retirement money, all the income and gains generated by that investment are subject to tax. Whether it's ordinary income tax or capital gains tax, it is subject to tax. If you invest and do the same investment in a retirement account, whether it's tax deferred like a pre-tax IRA or a Roth where it could be tax-free, you don't pay tax on all the income and gains generated. And that's the whole concept of tax deferral. Your money keeps growing, growing, and growing, and growing without tax. Whereas if you did it with personal funds, you pay a tax toll each year or each time there was income or gains, which would significantly limit your growth. And that's really the incentive for all of us to save for retirement. Of course, if you use a pre-tax IRA, pre-tax 401k, you'll also get the immediate tax deduction, which is wonderful. But the real power is on the power of deferral. So an IRA is only $6,000 or $7,000. So the tax deduction, let's say you're in the highest tax bracket of 35%, it's only $1,800 or so of actual tax deduction, meaning reducing your tax liability. The real juice and the real power is having that $6,000 grow without tax. So whether you're buying Apple stock or buying real estate or cryptos or gold or tax liens or hard money loans or private business investments, all your income and gains go without tax. Right, so the compounding rate of return is clearly very important, right? It's the eighth wonder of the world. The idea is your money doubles every 8 years. As long as you average 8% rate of return, your money's going to double every 8 years, and you get to accelerate wealth, right? So do you want to do a Roth or not Roth? That's the million-dollar question. There's no right answer, unfortunately. It's really interesting because in my estimation, I always look to take advantage of inefficiencies in the market. And here in the pre-tax and Roth situation, you have an inefficiency. You have two types of retirement accounts treating the income generated differently. So if you generated income in a pre-tax IRA, you pay potential tax when you pull it out. And that same investment, if you did in a Roth, so long as you're over 59 and a half, the Roth has been open 5 years, you'll never pay tax on that money ever. So there's a situation where the same income is taxed differently depending on whether it's in a pre-tax or a Roth. So I look at that as an inefficient marketplace or an inefficient product, and I want to take advantage of it. So where is the advantage for me? I'm 43 years old. I've been doing Roths for pretty much 20 years. And I see the inefficiency is the fact that I believe that over the next 30, 40 years, however I'm able to continue to earn income, I'm going to generate more wealth and more growth than I would if I benefited from that tax deduction. So no matter where my tax bracket is in 30 years or 40 years, and hopefully I'll be at a high tax bracket, the fact that my money is growing tax-free is a win-win for me. I will do without the immediate tax deduction, and I battled my accountant on this for a little bit, but I'm okay with that because, again, if you look at whether it's a $6,000 IRA or even a $19,000 pre-tax IRA, then let's say it's a 30% tax rate, you're looking at either $1,800 or $5,500 in a 401k. That is money, don't get me wrong, but I think I could do a whole lot better over the next 30 or 40 years and pull that money out tax-free. Never have to take RMDs because there's no RMDs for a Roth IRA, which we'll get to in a minute. And I can pass that on to my kids or spouse through a stretch IRA, which we'll also get to. So I'm a big Roth guy. Yes, is there a chance, and I get this a lot, can the government in 20 years come back and say, sorry guys, we're not going to respect the Roth anymore? Tough luck. I guess anything's possible. I do believe they probably grandfather people in. The possibilities there, clearly, because what's happening is the government now has been very pro-Roth, believe it or not. And the reason they're pro-Roth is because they're worried really over the next 4 to 8 years about immediate budgets. So their attitude is, well, let's get people in a Roth because they don't get that tax deduction. And the tax deduction is going to lower our tax base. And if our tax base is lower, we're going to have less money to spend on the military, to spend on healthcare, or spend on roads, education, and that's not going to be good, and that's not going to help get us elected. So we want to keep our tax base large. So by incentivizing people to do Roth IRAs, they're hopefully going to pay more tax. Now, of course, it's short-sighted. It makes no sense overall, long-term, 25, 30 years. It's really stupid, for lack of a better word. But as my congressman explains to me, I don't worry what's going to happen in 25 or 30 years. I'm probably not going to be around. I'm worried about the next 4 to 8 years. I'm worried for my constituents. I'm worried about myself. And that's just the cold, hard truth. So, yes, is there a chance in 25, 30 years the government says, hey, we need to pay and support Social Security. We're running out of money. This Roth thing is killing us. Let's convert it to pre-tax and make everyone pay tax on the money. Very unlikely. Is it possible? Yes, but unlikely. So I guess that is the only downside of a Roth, other than if you're 50 or 60 years old, the growth opportunity is much shortened than if you're 30 or 40. And of course, if your tax rate is going to be high, higher than it is now, maybe you want to stay away from the Roth. But again, I think the only real reason for not doing it is you believe the government's going to not respect it. Otherwise, I think the Roth makes a lot of sense. Let's talk about the strategy. So I basically carved out about 7. There's the backdoor Roth IRA, which I didn't include, which I'll talk about because I was worried I'd run out of time. But these are the 7 strategies that I think we want to focus on. And I just talked about the Roth pre-tax. We'll get into Roth conversions, levered real estate with a solo K, after-tax contributions in a solo K, circumventing Roth 401k and RMD rules, the stretch IRA, and making Roth IRA excess contributions. Now, this is a lot. This is some advanced materials. So bear with me if you have questions or I'm going too fast or I'm just a little bit too advanced. Reach out to me. I apologize, but I do want to tackle these topics because I get a lot of questions from people about these areas. And I believe most of my clients are not your average investor. Most of you guys are pretty sophisticated. Of course, number one, you found out about the self-directed IRA, so you're smart. You decided to use IRA Financial, so you're brilliant. And most of you guys are really seeking, I think, more sophisticated retirement type of education. So that's what I want to provide all of you and help educate you and share just a little bit of my knowledge with all of you. So we talked about the Roth and pre-tax, right? There's no right answer. Age is paramount. The younger you are, I think the more value Roth has. Your income tax bracket matters, I think, where it will be in the future. I'm not so focused on that. I hopefully will have a high tax bracket when I retire. That's the goal, right? And I'm still a big Roth guy. Obviously, if you think you're going to hit a home run, you invested in Uber as an early stage investor. Roth obviously makes more sense, and where your future income will be. Again, the government position with Roth, I don't think it's going to change. I don't believe they're going to go back and just start taxing Roths. I think if they do that in 20 or 30 years, our country's in probably a lot worse shape than we realize. And I think we got a lot bigger problems than taxing our Roth income if the government is desperate to tap into the Roth. But I guess that risk does exist. So Roth conversions is another nice strategy. Obviously, you want to do a Roth conversion when your account is low or when the asset you want to convert is low. Why? Because you pay tax on the fair market value of the conversion. So if you bought Apple stock at $500 and now it's at $200 and you think Apple stock's going to go up again, then you may want to do a Roth conversion on that in-kind asset. Same with real estate. You bought a piece of property, $225,000, it's worth $160 now, the market's tanked. You have the money to pay the tax, which is important because you got to pay the tax on your return. Whatever the value of that asset or cash you're converted gets transferred to your tax return and is treated as income. So for example, if you made $100,000 as a lawyer and you're doing a Roth conversion on $100,000 of cash in a pre-tax IRA, converting to Roth, you now have your you now have income of 200,000, and now you have to pay tax on the 200,000. So you got to make sure you got enough cash to pay for the tax. Using some of that Roth conversion to pay for the tax kind of defeats the purpose. Not a big fan of that. The good thing is there's no 10% early distribution penalty. Before 2010, if you made certain amount of money above a set threshold, you were not allowed to do a Roth conversion. That changed in 10 because the government needed money. The government likes Roth conversions because they like to get money, just like they like pre-tax. They don't like pre-tax, they like Roth IRAs. They love conversions because you're paying tax up front instead of in 20 or 30 years when you do an RMD on that money. So they love conversions. In 2010, in fact, they let you pay the conversion over 2 years to incentivize people to do conversions because their tax base was shell-shocked because of the 2008 financial crisis. So they needed more revenue, and conversions was a great way of doing that. For solo 401ks, you can do in-plan Roth conversions. Just make sure your plan allows for the conversion. No 10% penalty, but tax on what you convert. Whether it's cash or an in-kind asset, clearly cash, you don't need to value it, right? It's cash is cash. Publicly traded stocks, mutual funds, you don't really need to value it because it's going to be based off what the day of conversion. But liquid assets, in-kind assets, real estate, private equity, tax liens, precious metals. I'd say cryptocurrencies is more like equities because there is an ascertainable value on a day-to-day or even hour-to-hour or minute-to-minute basis. So you could lock in a price and do a conversion at that point. A little bit harder, clearly, on real estate. You're going to need to get an independent value because it's a taxable transaction. So if you are, for example, under 70.5 and you had an IRA with IRA Financial Trust, we would not make you get an independent valuation of the real estate to give us a value for the Form 5498. But if you're taking that property as a taxable distribution or you're over 70.5 years old, we would want an independent valuation because it's a taxable event. Is a discount possible? Potentially. Why would you take a discount on the conversion? So this is known as a discount valuation strategy. It's been used for 20, 30 years by high net worth individuals, basically in family limited partnership. When you transfer assets to a trust or a limited partnership, you try to take a discount on what was contributed, either because it's not marketable, it's a raw piece of land, or it's a minority interest in a closely held entity. So for example, if me and my friend wanted to start a pizza restaurant and I was going to put in $100,000 for 80%, and he was going to put in $20,000 for 15% or 10%, his value, if he went to sell that, would probably not equal the fair market value, because if someone bought his interest, they have a minority interest, they have no control over the entity, no control over the bank account, they don't have control over the future of the business. They're basically in secondary position to me as the controlling owner. So it has arguably less of a value. You're not going to get fair market value for that. So the concept is, let's take a discount. So I've seen this in the self-directed IRA, solo 401k world. If a self-directed IRA invests in an LLC that maybe has raw land, that's for a minority owner in an LLC, and other investors are there, maybe you take a discount valuation because of the minority interest or the liquidity of the asset. But again, you need to get an independent appraiser to value that investment or asset. And then obviously you're always subject to IRS audit. Even if you have a valuation from an independent party, the IRS does not have to accept it. Clearly, if you have an evaluation, it could help against penalties, for example, but they don't have to accept it. There's a new conversion rule that came into effect this year that basically says, in the past, you were able to do a Roth conversion, and then so long as you, before 12/31, you could basically refute the conversion or amend the conversion or revise it and pretend it never happened. So people were doing all kinds of Roth conversions, like 1/1, 1/8, beginning of the year, and if the stock or the asset appreciated, great. But if it went down in value, they would just pull the conversion and do it all over again. The IRS said, no, you can't time the conversion. Like once you do it, it's written in stone, you're done. So that's kind of changed things up a bit. People now have to think more long-term instead of trying to reap some short-term benefits. Okay, the next one is leveraging real estate with a solo plan. So I've done a bunch of Forbes articles on this. It's in a few of my books. I've talked about UBTI on our last webinar. Unrelated business taxable income is triggered in 3 instances with a retirement account. Margin by stock, an IRA or 401k invested in an active trader business like a restaurant through an LLC or other pass-through entity. Or in the case of an IRA, the IRA uses a non-recourse loan to buy real estate. And a non-recourse loan is a loan that's not personally guaranteed by the IRA owner. There is an exemption for 401ks under 514C9 of the code. That means if you use a 401k to buy real estate and use leverage, a non-recourse loan that is, you could be exempted from the UBTI tax of 37%. So that's obviously another inefficiency, right? Why, if you do the same investment, use leverage in a retirement account, why should it be taxed differently if you use an IRA or a 401k? It makes no sense. There's no reason, no justification for this. So someone who's intelligent would want to take advantage of this inefficiency. So the way to take advantage of the efficiency is see if you can buy that same asset, the real estate, use the leverage, but do it in a solo 401k plan. That is taking advantage of the inefficiency. Of course, you need to be eligible to establish a solo 401k. How are you eligible? You need to be self-employed. You need to have a business with no full-time employees other than yourself, another owner or a spouse, and there needs to be a business. So if you can somehow, and it doesn't have to be a full-time business, right? You can be a full-time lawyer, doctor, accountant, work at Fortune 500 company, work at a small business, and also do some stuff on the side, whether you're a math tutor or sell shoes on eBay or even are Santa Claus on Christmas, as long as you generate some self-employment income, whether it's a sole proprietor, a Schedule C, or a single member LLC, or a C Corp, S Corp, as long as you have a business that generates income and there's no non-owner employees over 1,000 hours, you're eligible to do a solo K, and then you can supercharge your returns by using a non-recourse loan to buy real estate. So you're probably going to need at least 30 to 40% cash down. Most non-recourse lenders will require that. You also may pay a few extra points. So there is a cost for doing a non-recourse loan. Why? Because the lender is taking some added risk because you can't personally guarantee the loan. So if you default, all the lender can do is go after the asset. They can't go after you personally. So the lender is taking a sliver more of risk, and they're going to charge you for that. But if you did that in an IRA, you pay UBTI tax on a percentage of the income attributable to the loan. So for example, if you invested $50,000 in cash in an IRA fund and borrowed $50,000 on a non-recourse basis, you have a 50-50 debt to equity ratio. And if the property generated $10,000 of net income after allocated depreciation and related expenses, 50% of that $10,000 or $5,000 would be subject to this UBTI tax of 37%. If you did in a solo K, you would have no UBTI tax, which is great, right? So you're able to supercharge your 401k and use leverage and not pay any UBTI tax. One way to minimize the UBTI tax, if you can't get into the solo K, you're not self-employed, C Corp blocker. President Trump signed in the 2017 Tax Cut Jobs Act, and it reduced the C Corp tax rate from 35 to 21%. That means you can set up a blocker and have the real estate, have the IRA invest in the C Corp buy the real estate, and then you pay only 21% tax on the profits associated with that real estate. But it's going to be 21% on all the profits. So you have to run the numbers, because if you're using very low leverage, say 20, 30%, maybe cheaper paying the 37% on that percentage of leverage than paying 21% on all the income associated with that property. So you just got to run the numbers, but obviously it makes the most tax sense if you were self-employed and you can get into a solo K, because you don't have to pay tax on the UBIT. After tax contributions in a solo K or non-deductible, this is something that I wish more people took advantage of. I still don't understand why people are not taking advantage of it. If you have a solo 401k, please, 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 please listen up. Okay, what I'm about to tell you could help you enormously sock away a lot more money than you're doing in a solo K. So with a solo K, in 2019, you could put away $19,000, $25,000 if you're over 50 as an employee deferral contribution. That can be in pre-tax or Roth. Okay, so long as your plan allows for it. And then the second component is the employer profit sharing contribution, which will let you put away 20% if you're self-employed or a single member LLC, or 25% if you're a member of a partnership or C Corp, S Corp, up to an aggregate of $56,000 if you're under 50, $62,000 if you're over 50. So for example, you're in 40,000 bucks, self-employed, okay, under 50. You can put 19,000 plus 20% of 40, giving you another 8 for about 27,000. If you're over 50, you can do 25,000 plus 20% of 40, your income on that example, giving you 33,000. Okay. The employee deferral could be in pre-tax or Roth. Employer contribution must be in pre-tax, but can be converted into Roth if your plan allows for it. Notice 2014-54 basically is included this ability if your plan allows for after-tax contributions, which is basically in between your pre-tax and your Roth, right? Your pre-tax, you get a tax deduction up front, but when you're over 59 and a half, you have to pay tax on the income generated or whatever you pull out, excuse me. A Roth, no deduction, right, on the amount you put in, but once you're over 59 and a half, the Roth's been open 5 years, you never pay tax on what you pull out. After tax is in the middle. It's like no man's land. You kind of don't want to be there. Why? You don't get that tax deduction on the money you pull in, and all the income and earnings from the contribution amount is subject to tax. So you don't really benefit. But you're able to make after-tax contributions and then convert to Roth and then dump it into a Roth IRA. So what does that mean? It means that you can not just do 19,000, not just do 20 or 25. You can do the full 56 or 62,000 if you're over 50, so long as you have enough income in after tax and then convert it to Roth. That means if you earn, let's say, $60,000, you can put the full 56 in if you're under 50, and then convert it to Roth and move it into a Roth IRA. 2014-54 lets you do it. If you didn't have the after-tax component option, if you didn't know about it, the plan didn't allow for it, you'd be stuck if on a $60,000 salary, you'd be stuck doing 19,000 or either 20 or 25%, which is way less than the max at 56,000. So the after-tax contribution option allows you to supercharge that return, supercharge the contribution, meaning you can go dollar for dollar up to 56 or 62,000, do an immediate conversion to Roth, and then move it to a Roth IRA. Before 14, you couldn't do it because they wouldn't let you bifurcate the Roth and the pre-tax, and it was impossible to do. After 2014, you're able to do it so long as your plan gives you that option, and now you can basically do it dollar for dollar. Another huge opportunity, another huge advantage of the solo K. If you work for Amazon or Apple or IRA Financial, you couldn't do the after tax. Why? It's subject to its own test, basically a top-heavy test, and unless most of the employees in your business did it, you would fail the test and you wouldn't be able to do it. That's why if you work for a company that has 10 plus employees, you're not going to see many people doing, or really any company doing the after tax, because you're not going to have enough people doing it. But in the solo K, you don't have to satisfy any of the ADP, ACP, or top-heavy testing because you're the only person. You're not subject to ERISA. Thus, you can do the after tax so long as your plan allows for it. Doing the after tax is going to let you hit your maximum super quick. Obviously, you're going to need to want to do Roth because to just leave it in after tax doesn't make sense because you don't get the tax deduction. And the earnings on the contributions will be subject to tax when you pull it out, like a pre-tax. So you want to make sure you're doing that conversion to Roth and then moving it to a Roth IRA, which is the secret sauce. If you are a big pre-tax person, you don't want the Roth option, you hate Roth, then the after-tax may not be a great solution. However, I implore you to consider it because if you made $60,000, $70,000, $80,000, you can do a full $56,000 or $62,000 if you're over 50. Whereas if you earned that and you didn't do the after-tax, you'd be subject to the $19,000 or $25,000 plus just the 20 or 25%. So again, even if you made $100,000, right, and you're over 50 in a S corp, you can do 25,000 plus 25% of 100, giving you 50. If you did after tax, you can hit the full 62 on 62,000, right? Much better. The only time it doesn't really help this after tax is if you make 250 plus and you're going to hit your maximum anyways, or if you're not a Roth person. But for everyone else, the after tax is really the secret sauce. I don't know a better word to say. It's the magic potion. I wish more people knew about it. I'm amazed how many people I speak to and who make 30, 40,000 bucks and love Roth, but don't do after tax because they don't even know it exists, or they're in the wrong plan, or they're using a plan that doesn't have the option. It drives me crazy. This is, if you take anything away from this presentation, if you're in a solo K, this is what you need to take away. I don't care if you don't care about conversions, you don't want to deal with Roth IRAs, you don't care about investments. If you just have a solo K and you learn anything from this presentation, please, 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 this is what you should consider, the after-tax contribution. I can't tell you this more clearly. Imagine if you were able to supercharge over the next 20 years and dump another $25,000 into your plan over the next 20 years. Right, that's could be $1.5 million, $2 million at the end of the day when you take into account income and earnings on that can grow tax deferred or tax, especially tax free because it's a Roth. I can't even say it more clearly. Please at least think about it. If you have questions, let me know. Happy to talk this through. But it really is something that is just not taken advantage of, and there's no reason for it, really. Let's talk about, let's say you do have a Roth solo K and you are getting close to 70, listen up. So a Roth IRA, there's no requirement of distributions, meaning you never have to pull the money out until you basically you die, your wife dies or your spouse dies and your kids or non-spouse inherits the Roth and then they have to take some of it out. It's not subject to tax, but they got to take some of it out. If you're over 70 and you have a Roth, there's no need for an RMD. You can, in fact, keep making contributions so long as you have income, which is beautiful. If you pass away, your spouse can take the Roth and it would go into his or her name, no RMDs. When the spouse passes away, then it can go to a non-spouse and then they're subject to RMDs, but no tax. But if you kept the money, let's say you're 65, or let's say you're 70 years old and you have your solo 401k and you still work, you're a lawyer and you can't retire because you love practicing law, and you love your clients, if you moved your money from the 401k to a Roth IRA, you would not have RMDs. But if you, for some reason, wanted to keep it in the solo K, you would have RMDs. Again, this is an inefficiency. It makes no sense. Why do you have to take RMDs in a Roth 401k, but not in a Roth IRA? It makes no sense. It's the same issue with the leverage. Why would you pay UBTI tax in an IRA, not a 401k? Same idea with Roth IRAs versus traditional IRAs. Why is the same income, same asset being taxed differently? So here it's very simple. If you're 70 and a half and older and you love the Roth and you still work, just move the money. Because you're over 59 and a half, you're going to have a triggering event. You can move the money out of the Roth 401k to the Roth IRA anytime. You don't ever have to pay tax on that money, clearly. And you don't need a triggering event because you're over 59 and a half. So what that means is the RMD is based off the value of your Roth solo K as of 12/31. So long as the value of the Roth solo K is 0, 12/31, you have no RMD. So what do? Just start in December, whether it's December 1 or December 30th or December 31st, just make sure by midnight, December 31st, that you have no money left in your Roth 401k. Everything's been rolled to the IRA. You can still do the same investments in the Roth IRA as the Roth 401k, so long as you have a self-directed Roth, but you're not subject to the RMDs. You don't want to be subject to the RMDs, especially if you don't need the money, because the whole beauty of a Roth is that's going to grow tax-free. It can grow to your spouse. It can go to your kids or a non-spouse beneficiary and keep growing without tax. So that is very important. There's no need to take RMDs if you don't need to in a Roth solo K. If you're getting close to 70, you need to consider these rules. You want to make sure that you have a zero balance as of 12/31. If you're 55, 60, 65, you don't really need to worry until you're 69 or 70 because there's no RMDs anyways. But if you are 70 plus and you don't need the money, you definitely want to have, and you have a Roth solo K, make sure you got a zero balance as a 1231. Just do a tax-free rollover to a Roth IRA, and you don't have to ever worry about RMDs. Stretch IRAs, very interesting area. Very more of an estate planning issue, but I'm going to touch on it. What does a stretch IRA mean? Basically, like the name says, you want to stretch out the IRA for as long as you can because you want that IRA to grow. And the longer it's alive, the more it grows. And just like the dragons in the Game of Thrones, the longer these dragons grow and get older, the more powerful they are. So the stretch IRA is the same idea because it takes advantage of the powers of the IRA. The longer your IRA is in existence, the more money likely you're going to have in it. So the whole strategy is limiting the RMDs. Basically, the way it works is if you have a spouse who you don't think is going to need the money, you may want to list a younger person as the beneficiary of the IRA, because what's going to happen is when you pass, the RMD is going to be based off the younger person's age, and hopefully that younger person's in a lower tax bracket and will be able to stretch that IRA over his or her life expectancy. Now, if you leave it to a spouse, obviously there's no stretch, right? Because the spouse is just going to put it in his or her name, and it's going to be based off their age. Again, unless your spouse is 30 years younger than you or 20 years younger than you, then you don't really have to worry about the stretch because you're going to have an automatic stretch by having it go to that younger spouse. But if your spouse is within a bunch of years of you, and you want that IRA to grow, your spouse isn't going to need it upon your death, you may want to consider the stretch IRA because you can stretch the growth of it. You can list a younger non-spouse individual as a beneficiary, and then it will be based off their life expectancy, and hopefully they're at a lower tax bracket. They'll pay less tax on that money, and it's going to grow longer. One thing to note, if you have multiple beneficiaries, you got 2 or 3 kids, then it's going to be based off the age of the oldest beneficiary. Another thing to consider, trust. If you name a trust, a lot of people like naming trusts. That's fine, okay, but make sure your estate attorney and discuss it with him or her. That it could reduce the stretch to a 5-year term if the person's less than 70 and a half. So a lot of times people make this mistake. They leave a trust in there and they want to do the stretch, and then the stretch gets limited because of the trust. So just be cautious of that. Good attorney will catch that. Clearly the stretch works if your spouse doesn't need the money and you have young non-spouse beneficiaries that you want to leave the money to and you trust them to take good care of the money, then they'll be in a lower tax bracket potentially, and the IRA can stretch over a long period of time. If your spouse is a lot younger than you, then that may work itself out and be kind of an automatic stretch because the IRA upon your death will just move into the name of the surviving spouse and his or her name, and then it will be based off their age. If they're under 70, there's not going to be any RMDs anyways until they reach 70. If your spouse is over 70 and you pass, this is when the stretch IRA makes sense, because if you left it to a non-spouse who's 30 or 40, that person may have a longer period of time to use up that money and be in a lower tax bracket than your spouse. But again, there's a lot of estate planning issues to think about. You definitely want to talk to an estate planning lawyer. Don't try to do this stuff yourself. Definitely talk to counsel, whether you want to use a trust or not, what type of trust, and the best way to maximize the stretch IRA provisions. There's been some chatter. The IRS has looked into, the House and Ways Means Committee has looked at a way of potentially limiting the stretch. It's never kind of gone off the ground. I don't see the benefit. There's not enough people taking advantage of it. So not sure that's ever gonna fly, but it's something that the IRA and the House and Ways Means Committee have looked at the stretch IRA. Excess Roth IRA contributions. This is an area that just be cautious about it. Basically, what this is about overstuffing your Roth IRA. Basically, the excess contributions is IRAs are $6,000 if you're under 50, $7,000 if you're over 50. What happens if you put $100,000 in or $8,000 in? What's the rules? So the penalties and tax apply differently if you have a traditional Roth. Again, we're back to inefficiencies in the marketplace or inefficiencies in the IRA retirement world. Why is it a different situation? Why do you have a different predicament if you're in a traditional or Roth? Why are there different penalties and tax ramifications? And here you're going to see there are. Traditional IRA, you're going to pay 6% tax per year as long as the excess amount is alive. And if you're under 59.5, there's a 10% early distribution penalty and income tax. Okay, although the earnings generated from the excess would remain in the IRA, but they're still subject to 10% tax and a 6% excise tax. In a Roth IRA, very interesting enough, you get subject to the 6% excise tax. However, unlike a traditional IRA, there's no early distribution penalty or tax on the excess contribution. So believe it or not, I've had people call me up and say, hey, why don't I just put $100,000 in the Roth? I'll pay 6% tax, no problem. I'll give you $6,000 to the IRS each year, okay? But I now stuffed or overstuffed my Roth IRA by that amount. I'll pay you 6% happily, IRS. All that money stays in my Roth IRA. There's no tax or 10% penalty. Sounds pretty good, right? 6% is less than ordinary income, less than a capital gains tax. It's a home run. Why wouldn't everyone do it? Well, a lot of people, not a lot, but people are doing it. There's some people telling people to do it. I am not one of those people. I think the IRS could find this abusive. They've actually, there's a pilot program where they kind of sent soft notices to taxpayers talking about this. There's some chatter about them going after taxpayers where they see egregious overcontributions. Not talking about $100 or $1,000 errors, talking about 50,000, 100,000. I haven't heard, there's some cases out there. Most of the cases and most of what I've heard is the IRS just basically slapping you with a 6% excise tax, which isn't horrible. In fact, I've seen cases involving discs, which are ways that you can structure if you have some foreign sales. You can set up what's called a disc where you could basically remove the tax on income earned overseas from foreign income. I've seen them, even in egregious cases, instead of arguing for steeper penalties, just kind of slap a 6% excise tax on that, which isn't horrible. It's much better than ordinary income or 10% penalty, which, like a prohibited transaction, in some of these cases, the IRS is having trouble kind of positioning where these cases fall. They're not prohibited transactions because they're not violating 4975, although they're pretty egregious. I don't know if they're fraudulent, but they're egregious. How do you penalize these people? And do you penalize? And do the rules give you ammunition to penalize? So I do think the IRS clearly has that 6%. We know in a Roth, they can't hit you up with tax for 10%. What do? They don't really have enough ammunition to go after you. There's not enough weapons in their arsenal to find other penalties. So a lot of times they're sticking a 6% tax. Now, I've talked to IRS agents where they'll try to invalidate the Roth. They'll say this is basically erroneous contribution or fraudulent contribution. We're not going to respect it because it's so egregious. But I haven't seen case law that allowed them to do so. So in some of these cases where there is overstuffing, not even errors, right? When someone's putting in 50,000 instead of 5,000, clearly not errors, but overstuffing. I've seen 6% penalty, excise tax. I haven't seen anything else. So I'm not telling people to do this. I think it's highly risky. You're playing with fire, but the law allows you to do that because the penalties are just excise tax. You don't want to do an traditional IRA. It doesn't make a lot of sense because you're paying 10% and tax and 6%, but the money does stay in the IRA. The Roth is obviously the inefficiency, right? You just pay 6% tax, excise tax, like big deal. You don't pay 10% penalty or ordinary income tax, and you now overstuffed your Roth IRA. I mean, who wouldn't do that? If we all knew the IRS wouldn't come after us and try to argue any type of fraud or fraudulent contribution or any type of penalties other than the excise tax, I think everyone in their right mind would just overstuff their Roth IRA each year. I would do it, but I haven't because I'm not sure how the IRS would treat that. I've written a blog about this. There's some Forbes articles on it. I wrote a Forbes article on it actually, and they didn't want to publish it because they thought it was a little too aggressive. But again, the rules are the rules, right? The rules just say 6% excise tax. That's what the law is, even though the IRS could argue something else. That's kind of where they're at. So just tread lightly. I'm not sure how the IRS would treat this. There were soft notices sent out. They are aware of this stuff. There's notifications online about over contributing to a Roth, but they just mention the 6%. They don't mention if they're going to go after like a step transaction, fraudulent conveyance, fraudulent contribution. They haven't talked about that. The last thing I want to talk about is, again, the backdoor Roth, which is a great strategy. I have a couple minutes, so I'm going to jump into it. Backdoor Roths mean if you earn over, I think the limit for 19 is about 204,000 married filing jointly, you're not allowed to do a Roth contribution. Okay, so how do you get around it? You basically do an after-tax IRA contribution. You don't get the deduction, and then you can convert to Roth, and now you've just did a backdoor because you didn't make a direct Roth contribution, but you did it through an after-tax and then convert it to Roth. One thing to be concerned about or weary of this is if you have other IRA money, the conversion is pro rata. So if you had $100,000 in your pre-tax IRA and you did this backdoor conversion, not the entire 6,000 of IRA contribution will not be Roth. You're going to have to add the 100 and the 106,000 and divide it by 6, and then that percentage will be Roth, and everything else will still be pre-tax. So it's going to take you some time to get that backdoor fully Roth. But if you don't have any pre-tax and all your money's Roth, then the backdoor works because you don't have any pro rata formula issues. You just can automatically convert back after tax to Roth. So that's another strategy that I'm happy to have a couple minutes to chat about. So overall, just kind of go through these strategies again. It's all about inefficiencies in the marketplace. That's what I look for. How do you take advantage of inefficiencies that don't have any real merit, right? They're just different rules for the same income, different rules for the same asset, different rules for the same categories of income, and there's no justification why they're taxed differently, like leverage in a solo K, like the circumventing the RMD rules. Why is there a Roth solo 401k RMD but not a Roth IRA? The excess contributions in a Roth IRA. Why did that 6% excise tax only apply to Roth and then not have the tax and the 10% penalty like the pre-tax? So those are the three big inefficiencies. The Roth versus pre-tax clearly is you have the same income, right? Rental income or capital gains being not taxed ever in a Roth and then potentially being subject to tax on a distribution or pre-tax. You have solo K or 401k that doesn't pay UBTI tax on leverage in a solo 401k and an IRA does. You have excess contributions that get beneficial treatment in a Roth, and you have the different RMD rules for a Roth IRA and a Roth solo K. So I hope these strategies were helpful. I think if you have a solo 401k, definitely want to look at the after-tax contribution issue or option to make sure that this applies to you and you have some, if it works for you, you have some opportunities. Otherwise, you should look at the inefficiencies and see how you can take advantage of them if you can. Okay, someone wrote, I have a solo 401k and I work as a W-2 with an employer, and I also have my own sole proprietor, my real estate business, which doesn't generate income for some years. Do IRS question if my solo K is valid? Probably not. You want to show you have an active business. So, I mean, if you're retired and you have no expenses, no income, and you do nothing for 2 or 3 or 4 years, yeah, you may want to think about closing the solo K down and maybe moving to an IRA because the IRS maybe will question whether it's a valid business. But if you have some expenses or you had off 1 or 2 years where you kind of didn't have a lot of activity, that's okay. The IRS is not in the business of invalidating plans. They don't want that to happen. They like when people have 401ks. They want people to save for retirement. So that's not their really their motive. But they do want people to follow the rules. So I think after a few years, if it's really nothing going on in your business, either because you're a busy full-time employee or you just kind of moved on to something else, then maybe you want to move into a self-directed IRA. But if you still have some expenses, you're still taking courses, you're paying for your license, you have other expenses, office space, then you don't necessarily need income. You just want to show activity. You want the IRS to see there's a business, it's not a hobby, and it's active. Can you buy Bitcoin in a solo K? Yeah. So again, there's only two things you can't do in a solo K. You can't buy collectibles like art, and under 4975, you can't do any transaction that directly or indirectly personally benefits you or a disqualified person, yourself and any lineal descendant, parent, child, spouse, daughter-in-law, son-in-law, or any entities controlled by such person. So yeah, you can buy Bitcoin, buy real estate, tax liens, tax deeds, precious metals, private businesses, hedge funds, private equity, options, foreign currency, all that's good. Can you make contributions to a solo K with tax deferred income? No, you need to earn the contributions to a solo K needs to come from income you earn that you are subject to tax. So not Social Security, it's called earned income. Not Social Security, not disability. You need to earn the income. So if you're sitting on a beach because you're a gazillionaire and you don't have to work ever again, or you play golf, or you're disabled, God forbid, or you just don't ever want to work, if you have no income, you can't make contributions to a solo K. Okay, the income, and which is important, the income needs to be earned from the business associated with that plan. So if your business is a real estate business, you need to earn, and the solo K is attributable to that real estate business, the income needs to be earned from that business. If you make $1 million a year as a CEO of a software company and your solo 401k is from your selling shoe business, you want to put money in the solo 401k, you need to earn it from your shoe business. You can't earn it from the software business, okay? Because then that's attributable to another plan. You can make IRA contributions. That can be from earned income from anywhere. And you can piggyback off a spouse. So let's say your spouse works and you take care of the kids, or you're retired or whatever, you can piggyback off your spouse and make a contribution of $6,000 or $7,000, so long as your spouse has ample income. Okay, can you please help go through the execution of after-tax to Roth IRA? It's not clear if there's one 1099 or two that involve one after-tax to Roth, or second for Roth 401k to Roth IRA. So basically, yeah, what's going to happen is you're going to go after-tax to Roth, which would be a 1099, and then you would do Roth 401k to Roth IRA. I've seen people do two 1099s. It's always safer. I've seen people do one, but I probably think two, because after-tax to Roth is technically a conversion, and then you're going to 1099 rollover Roth 401k to Roth IRA. So I think you're going to want two 1099s. I'm over 65 with a solo K. How do I decide if it's better to do a Roth? I can have a beer and talk to you for an hour about that. It's a great question. No right or wrong. That generally, as a kind of a baseline rule, the older you are, the less power Roth has, because less opportunity to grow, right? 65 versus 25. But again, if you think you're going to hit a home run, you're going to buy Bitcoin, and you think it's going to go to the moon, or you're going to invest in a friend's business, it's going to be the next Uber, then the Roth still makes a whole lot of sense. But there's no right or wrong. Some years my sole proprietor had generated income, sometimes lost income. My solo K will be still valid? Yes. Again, it's not a 1 year kind of equation or test. You look at it at a 3 year, 4 year window. If nothing's happening for 2, 3, 4 years, then you may want to think about moving to an IRA. But if in 19 you had some income or expenses, you don't only need income. It could also be expenses. And let's say in 2020, you retired, you went to travel around the world, you did nothing, and then 21 you're back. That's okay. I think it's only when you have 2 or 3 or 4 years in a row of really nothing going on in that enterprise, you have no expenses, no income. At that point, you may want to move on from the solo K. Anything else? I think that's kind of it. So I appreciate everyone listening, watching, viewing. Thank you. If you have ideas for next topics for the next presentation, webinars, podcasts, videos, please let me know. If you have individual questions, you can always email me. You should all have my email, or you can email info@IRA Financial, or you can contact us on Facebook, Instagram, YouTube, Twitter. You can also subscribe to our YouTube channel. There's new videos, 2 to 3 new videos a week being posted. They're also posted to Facebook or Twitter. So you should subscribe to our channel so you can always get instant feeds. Same with our podcasts, which are done weekly. Adam Bergman, IRA Financial, thank you so much for taking the time on your busy day to learn how you can maximize your self-directed retirement plans through the strategies I discussed. Thanks and have a great day.